Welcome to Min Chao, where law, finance, and real estate complexities are made clear, actionable, and empowering. The information provided on this channel is for entertainment and educational purposes only and does not constitute legal, financial, or real estate advice. For advice tailored to your specific situation, please consult with a qualified professional. If you'd like to consult with us, please book an appointment through our website. Investing involves risk, and you could lose some or all of your investment. Past performance is not indicative of future results, so whether you're looking to protect your assets, grow your wealth, or make intelligent real estate moves, you've come to the right place. Chapter 3. What every beginner needs to know about easy options, strategies. You love your stock. You want to keep it. You hoped your stock would moon. Instead, it yawned. But thanks to that call, you sold and you still made money. But now it's doing something useful, bringing home premium treats while you sit back and collect like a proud stock parent. Welcome to your soft launch into the world of options trading. If diving into options has ever made you feel like you've accidentally wandered into a CrossFit gym, you're not alone. And more importantly, you're in the right place. This chapter is your calm, judgment-free zone. No complex formulas, no ego lifting, and no financial flexing. Here, we're focusing on strategies that are simple to understand, practical to use, and surprisingly effective. We will examine 3 beginner-friendly options, strategies that reflect a low-risk approach and foster steady growth. Covered call. The stock market side hustle. Imagine you own 100 shares of Snug Mug Inc., a company selling emotional support mugs. Instead of letting those shares sit idle, you decide to use a strategy called the covered call, which is like renting out your couch while still retaining ownership of your house. You sell a call option to someone who believes the stock price will rise. They pay you a premium upfront, which you keep regardless of what happens. If the stock price remains under the strike price, you retain both the premium and your shares. If it goes above the strike price, the buyer can purchase your shares at that price, which means you still make a profit, but less than if you had held on to the shares. Covered call payoff chart. Let's say you're the proud owner of 100 shares of Snug Mug Inc., a fictional company that sells cozy mugs and equally cozy vibes. You bought these shares at $50 each because you're savvy and maybe a little lucky. Instead of letting your stock sit around like a bored golden retriever waiting for a treat, you decide to put it to work by selling a covered call, a strategy that's kind of like renting out your stock to someone who might want to buy it later. You agree to sell your shares at $60 if asked, and in return, someone pays you a premium of $5 per share. Let's talk about the break-even point, the most important line on your financial dance floor. It's the point where your trade stops being a sob story and starts being a success story. In this case, since you bought the stock at $50 and got $5 from selling the call, your break-even is $45. That means even if Snug Mug tumbles down to $45 at expiration, you're still sitting at 0 net loss. That's the green line on the chart. Let's say Elon Musk tweets, "I drink only from Snug Mug." The stock shoots to $100. Sounds great, right? Well, not for you. Remember, you sold that call You agree to sell your shares at $60, regardless of the price. So you don't get to enjoy the ride to $100. You're like the person who sold concert tickets for $60 before finding out Taylor Swift was the headliner. You generated a profit of $15 per share, resulting in a total earnings of $1,500. If the stock crashes, like a TikTok star facing significant backlash, nobody is buying your stock at $60. Your option expires worthless. The beauty of the covered call shines through. Owning the stock limits your total loss to the difference between what you paid, $50, and the $5 premium you received. If the stock price drops to $0, your maximum loss will be $45 for each share, totaling $4,500 if you own 100 shares. It's a harsh setback, but it's akin to landing on a mattress rather than hitting the ground. Covered calls are a powerful strategy if your stock remains stable, showcasing the beauty of cautious optimism in the face of uncertainty. Cash-secured put, getting paid to window shop. You're eyeing a stock like it's a pair of sneakers you want, but you're not paying full price. You're waiting for that magical 50% off sale. What if someone paid you to wait for the sale? That's the cash-secured put in a nutshell. You're saying, sure, I'll buy these sweet kicks if they drop to $50, but until then, pay me $5 for even thinking about it. Let's break this down with a real example. Say you sell a put option on a stock called Snug Mug Inc. with a strike price of $50 and you collect a $5 premium for doing it. You're telling the world, if this stock drops below $50 by expiration, I'll buy it, but I've already been paid $5 to do so. Cash secured put payoff chart. In the chart above, that flat purple line at $5, that's you savoring your iced coffee as the stock remains above $50. You never had to buy the stock, yet you still earned that $5. That's your maximum profit. Then there's the green line at $45, your break-even point. This is your crucial milestone. If the stock drops below $45, you start to see losses. While you're paying $50, that $5 premium helps cushion the fall. Anything below $45 means your losses increase. If the stock plunges to $30, you buy it for $50. Painful? Yes, but remember, you were compensated with $5 for taking that risk. That's the journey of cash-secured put. Your profits are capped, and losses are a part of the adventure, but you are embracing the market with maturity and vision. Long call. The Optimist's magic bean. If you find yourself dreaming about owning a stock, but hesitate to spend your entire allowance or paycheck, consider the exhilarating world of long call options. Imagine securing a call option with a strike price of $50, where you pay a premium of $5. This purchase gives you the right, yet not the obligation, to buy a stock at $50 before the expiration date, much like reserving coveted concert tickets for a thrilling performance by Beyoncé. Long call payoff chart. Let's take a moment to gaze at the captivating green line in the graph. A line that might remind you of a lightning bolt striking with potential. This path represents your journey as a call option buyer, filled with optimism, resolve, and ambition. Initially, this green line remains steady, indicating a loss of $5 until the stock price surpasses the critical threshold of $50. Should the stock price linger below this mark, your option might seem to dwindle in value. But remember, every challenge is a teacher. Once the stock price ascends above $50, that green line erupts with energy, soaring high like a squirrel, buzzing with enthusiasm. Now, let's focus on the striking red line representing the strike price of $50. This line symbolizes your golden opportunity, a VIP entrance to the club profit, the exclusive space where dreams can transform into reality. Below this price, the path is rocky and uncertain. Above it, you soar to new heights. Don't forget about that $5 entry fee that paved the way for your journey. The green dashed line marks the sacred break-even point at $55, a beacon of triumph where you finally stop losing money. This pivotal moment is illustrated through simple math. $50 strike price plus $5 premium paid equals $55 break-even point. Every cent above $55 resonates with victory. As the stock price climbs, so does your profit, expanding like your wildest dreams. When the stock reaches $60, you pocket an extra $5. At $80, you bask in a gain of $25. And by the time it hits $500, the potential expands into a universe of possibilities. Let's acknowledge the blue dotted line that signifies your maximum loss, -$5. This line defines the limits of your worst-case scenario, ensuring that your loss remains contained to the premium paid, $5. There are no dramatic dives into despair here, only a polite and graceful exit, much like parting ways with a friendly wave at the end of a memorable gathering. A long call option is your gateway to chase significant gains while minimizing risk. In the worst case, you relinquish your $5 premium, but in the best case, you watch the stock soar and embark on an exhilarating journey of rewards. Wrap up from hopes to hedges. Congratulations! You now know that options don't have to be intimidating beasts that only Wall Street wizards whisper about in candlelit hedge fund meetings. They can be friendly, helpful, and, dare we say it, fun. It's like getting paid to wait, or getting paid to sell, or dreaming big with limited downside. Who knew finance could sound like a brunch menu? And the best part? You didn't need a PhD, a hedge fund internship, or a tolerance for caffeine-fueled Reddit threads to understand it. Just a curious mind and a desire to make your stocks work smarter, not just harder. So whether you're here to dip a toe or do a cannonball into the options pool, you've officially moved past total rookie and into smart but humble strategist territory. There you have it. Thank you for watching Min Chao's channel, where law, finance, and real estate come together for an enjoyable experience. Please like, comment, and subscribe for more tips and laughs. We look forward to seeing you in the following video.